Hello, I'm Dr. John Prudhont, DBA and MBA, and for this video I will be discussing the finance manager's role in a company. You might ask yourself, why is this video titled Gatekeepers, Success versus Getting Squished? If you watch the character Indiana Jones in the first movie of the Raiders of the Lost Ark series of movies lift the crystal skull and set off a chain of unanticipated and potentially life-threatening events, including a huge rolling boulder that he and his team has barely escaped, you probably weren't thinking that's similar to what a financial manager of a corporation does daily. I know I didn't. Of course, I was about 17 years old when the movie came out, so I had no idea how a corporation needed to work. So, what is the role of financial management in a corporation, and why would I compare the part to the role of Indiana Jones? One of the primary roles is planning. This includes financial reporting and financial policy, managing the accounting and finance divisions, and creating and implementing risk management and internal control systems. A financial manager might be responsible for setting targets for limiting overhead costs, limiting production expenses, debt service management, and achieving specific revenues, profit margins, and gross profits. Planning includes preparing investment options for any excess profits or committed capital while waiting for it to be deployed, and tax planning to keep the tax burden as low as possible through tax avoidance schemes. Financial management is also responsible for cost containment by setting spending levels, creating cost-cutting measures, in-house production or outsourcing, and minimizing interest payments and tax liability efforts. Cash flow management, which involves ensuring that there is sufficient working capital and liquidity, as well as the capital structure mix of internal financing, debt, and equity, and setting financial controls for the corporation is another critical role of financial management. Finally, legal compliance, including regulatory compliance and debt covenant restriction compliance, falls under the role of financial management. The main goal of the financial manager is to increase shareholder value. This is accomplished by providing relevant and actionable information to the board of directors or managing members to assist them with focusing on decisions that maximize profit while minimizing risk and optimizing the reward equation. The financial manager utilizes relevant financial data to directly affect processes in departments that they control to increase firm value at each opportunity while keeping any financing related costs low. So, how does finance affect the firm's overall strategy? From a long-term strategic perspective, finance assists the board of directors or managing members with making decisions by providing stakeholders with transparency and forecasting. Finance can reduce information asymmetry for the board of directors by providing evaluations utilizing trade-off theory, pecking order theory, etc., which can improve board efficiency and decrease the level of over or underinvestment. Since finance manages the finance and accounting divisions of the corporation, finance has the most direct daily influence on the firm's financing and accounting related decisions. This insight presents the board of directors with more timely information to utilize up-to-date data when making decisions for the corporation. The financial manager affects the firm's overall strategy by providing insight and information to the board of directors or managing members that impacts firm-wide and future performance. By creating and providing key performance indicators, also referred to as KPIs, to the board of directors or managing members and other levels of management throughout the organization, finance can stimulate the improvement of corporate performance. Through the composition and delivery of projections and budgets to the board of directors or managing members, the financial manager generates the tools for the board of directors or managing members to make more informed strategic decisions for the firm. These projections include project financing costs versus projected return that can consist of the use of financial modeling to determine if a given project might yield a positive net present value, also referred to as NPV, and through the use of the capital asset pricing model, also referred to as CAPM, because a firm contributes to value by investing in all projects whose incremental risk-adjusted expected return exceeds the marginal cost of capital. So, how does the financial manager aid in organizational growth? Stakeholders can make better decisions on how to best contribute to firm development through transparency into how each stakeholder's efforts affect the firm at all levels of the corporation. The financial manager is key to communicating the firm's financial commitments and cash flows to ensure that the decision makers and managers affected by the potential decisions have relevant tools to contribute to organizational growth. Corporations must take advantage of potentially profitable investment opportunities, and the financial manager provides resources to evaluate and make informed decisions supporting organizational growth. An organization needs to have a foundation of cash flow and liquidity to survive and for the organization to grow. The financial manager is key to ensuring that cash is available when needed through prudent management of cash investments and sourcing accessible financing when needed. The financial manager aids in organizational viability by decreasing information asymmetry throughout the organization, and especially for the board of directors, by providing relevant, current, and actionable information that can increase board operating performance and result in increased value through heightened profitability for the corporation. As we have discussed, the financial manager can use models and calculations like NPV and CAPM to assist the board of directors with making project investment choices to reduce over and underinvestment decisions that could damage firm viability. Risk management is a foundational requirement for corporate viability, and the financial manager contributes to firm viability by creating and implementing financial controls to mitigate risk loss. Through prudent liquidity management, key performance indicators or KPIs, and board of directors influence, a financial manager can provide a hedge against bankruptcy risk to organizational viability and to avoid getting squished by a monstrous boulder. I'm Dr. John Prudhont, Doctor of Business Administration and Financial Management and Master of Business Administration and Finance, entrepreneur, finance, business administration, and M&A expert. Thank you for taking the time to learn about the finance manager's role in a business. Please contact me at johnprudhont@gmail.com with questions or to book me for speaking engagements and appearances.